Do you know why every country is in debt and who they owe it to? Have you ever seen the news saying that the government is wasting billions of dollars on something ridiculous while the country is drowning in debt? People become furious and panic. But did you know that almost every nation on earth is in debt? India, Germany, Switzerland, Qatar, and so on. Even the major nations. The wealthy ones cannot escape debt. Japan owes twice the size of its entire economy. And what about the United States? A debt of $30 trillion, and it's still rising. Sounds crazy, right? So have you ever wondered why countries fall into debt? Why don't they just print unlimited money? Is debt really that bad? And if countries owe money, who exactly are they borrowing from? And can a nation ever escape debt completely? So in this video, we're going to discuss everything you need to know about debt. National debt, also known as public debt, government debt, or sovereign debt, is the total amount of money that the federal debt or central government owes. Just like individuals borrow money when they need it, governments borrow when they spend more than they earn. Instead of borrowing from a single bank, countries borrow from many different sources. These lenders can be other nations, large financial institutions, and even their own citizens. National debt only includes debt owed by the federal or central government. The U.S. national debt includes only federal government debt, not state or local debt. So debt from states like California or Texas is separate from the federal government's debt. States or provinces can have their own debts, independent from the central government. National debt also doesn't include individual debts like credit cards, student loans, or mortgages. So why does a government borrow when it could just print more money? If a government prints money recklessly, it will overspend, flooding the economy with cash. This leads to hyperinflation, causing prices to skyrocket and the economy to collapse. As a result, investors in other countries lose trust and see the currency as worthless. This happened in Venezuela and Zimbabwe. Borrowing, however, forces governments to stay disciplined to manage money more responsibly. The first reason countries borrow is to cover budget deficits. The government's main source of revenue comes from taxes, but sometimes it's not enough to cover expenses, leading to a budget deficit. For example, if the government collects $3 trillion in taxes, but needs $4 trillion to fund public services, they will be short by $1 trillion. So what are the options? Cutting spending would mean fewer services, worse education and healthcare, and people would be unhappy and might protest. Raising taxes would make life harder for everyone and could lead to even bigger protests. So, the easiest solution is to borrow money to cover the deficit. The second reason is to invest in growth, and borrowing is not always a bad thing. Imagine your country needs roads, schools, and hospitals, but the government has no money. Instead of building them now, they would have to wait years to save up, while people continue struggling with poor infrastructure and bad services. But if the government borrows money, they can build these projects right away, helping the people and improving the economy faster. These investments can boost economic growth. The third reason is to handle crises and emergencies. Sometimes, the government has no choice but to borrow. When unexpected events like war, natural disasters, or pandemics occur. For example, in just the year 2020 alone, the United States borrowed $3.8 trillion for COVID-19 relief, stimulus checks, and business support. Without that, the economy could have been much worse. The fourth reason is to pay off existing debt. Governments also borrow to repay old loans. Suppose a country borrowed money in 2020 and needs to repay it in 2020, but cannot afford to. So what do? Of course, they borrow another loan in 2021 to repay the 2010 loan. And this cycle continues, as long as the country manages its debt responsibly. But what happens if the national debt gets out of control? That's exactly what happened to Sri Lanka, a country that defaulted debt $51 billion in the year 2022, leading to protests and turmoil. Fourth and fifth, controlling interest rates and inflation. Sometimes governments borrow money as a financial tool, not just because they lack cash. By issuing bonds, they can control inflation and stabilize the currency. For example, when inflation is too high, the government can issue bonds to pull money out of the economy. Conversely, when the economy slows down, the government can borrow more to inject money and stimulate growth. The government doesn't borrow from just one source, but from three main sources: domestic, foreign, and the central bank. Let's analyze them more closely. First is borrowing from domestic lenders. You can lend to your own country by buying government bonds and treasury notes. You're essentially lending money to the government, and the government will pay you back that amount plus interest. Local citizens, commercial banks, some ETFs, mutual funds, and even companies also buy bonds as investments. Even government agencies can buy bonds too. Government agencies like Social Security in the US can use their surplus funds to purchase government bonds to earn interest. Through this, they can raise additional capital to provide more benefits. As of March 2025, about $7.3 trillion, roughly 20% of the US national debt, is intragovernmental debt. The second category comes from foreign lenders. Foreign citizens and commercial banks can also buy bonds. Foreign governments also purchase bonds from other nations, usually from more stable economies, to earn investment returns. Japan and China are the two largest holders of U.S. Treasury securities, with each holding about $700 billion and $1 trillion. If a country's economy is not strong, most foreign governments will not buy its bonds because they don't trust that weaker economies can repay. Instead, they prefer direct loans, where they can demand certain policy conditions and ensure that if the weaker economy cannot repay the debt, when countries need long-term capital for infrastructure projects, they borrow from institutions like the World Bank or the Asian Development Bank, ADB. These institutions provide direct loans. So if a country falls into a state of economic chaos, bankruptcy, and no one is willing to lend to them, they turn to the International Monetary Fund, IMF, their last resort. The IMF does not fund projects, but provides emergency loans to prevent financial collapse. IMF loans come with strict conditions, such as requiring higher taxes and spending cuts. The third source is from their own central bank. In theory, governments can borrow from their central bank. This is called debt monetization or monetary financing. However, most countries no longer do this today because it can devalue the currency and cause hyperinflation. Instead, central banks still buy government bonds indirectly. Is national debt necessarily a bad thing? Actually, not really, because debt can be good or bad, depending on how it's used and on a nation's ability to manage it. Debt can be beneficial when used and managed wisely. When governments borrow to build infrastructure and public services, this can stimulate the economy. And during crises like COVID-19, borrowing helps stabilize the economy and support businesses. So as long as debt remains under control, it's fine. But too much debt is dangerous. If a country keeps borrowing just to pay off old debt, it will fall into a debt trap. When debt rises too high, the country spends more on interest payments than on essential services. If investors lose confidence, they will doubt the country's ability to repay. This will lower its credit rating. Countries also have credit ratings. A poor credit rating makes borrowing more difficult. Investors stop lending or demand higher interest rates, leading to a debt crisis and possible default. So how much debt is too much? There is no exact number, but one way to measure it is the debt to GDP ratio, which compares a country's total debt to the size of its economy. Many economists consider 60% or lower to be a safe level, but this is not a strict rule. Some countries, such as the United States, have a national debt ceiling. So can a country ever escape debt? Technically, yeah. But in reality, almost no country is completely free of debt, and it's not even a good idea. So is there any country with zero debt? The answer is no. Every country in the world carries some level of debt. The closest example is Macau, but Macau is not a country. Macau can stay debt-free because it is very small and earns billions from casinos, even more than Las Vegas. We can't turn the entire United States into a giant Las Vegas just to pay off the debt. But even if a nation could get out of debt, most don't even try. If a country can manage its debt properly, debt can actually benefit the nation. Completely eliminating public debt would mean drastic spending cuts or massive tax hikes. Both could slow economic growth and spark widespread protests. Without public debt, there would also be no government bonds. which would remove an important safe investment option, a crucial one. Most pension funds rely heavily on government bonds. In short, debt is truly a double-edged sword. If used wisely, it can help a country grow. If used recklessly, it can lead to economic disaster. So the next time you hear someone ask, "Why is our country in debt?" you already know the answer. The issue isn't the debt itself, it's knowing how to manage it. And maybe you're still wondering why some countries handle high public debt so well, while others collapse under it. Perhaps we'll talk about that in another video, because we're out of time. If you want me to make more videos explaining topics like these, please like and subscribe. Thank you for watching.